Welcome everyone. It's great to be with you all today. My name is Natalie Jackson and I'm a consultant in the Knowledge and Learning team at A4S. Thank you for joining our Sustainability in Action webinar today on debt finance. Please note that we're recording the webinar for others and it will be made available on the A4S YouTube channel later this month. There are 3 learning objectives for this webinar. So after completing today's event, you will be able to understand the latest trends in global capital markets, appreciate the action that can be taken to ensure sustainable finance instruments are ambitious enough, and identify the role of the finance team in developing sustainable finance instruments. I'll provide a brief introduction to the session and we'll run through a few poll questions, which you'll need to complete in order to get CPE points. We're then going to hear from Melissa James from Morgan Stanley and Tom Stewart from Sainsbury's. A warm welcome to you both. We will have a panel discussion followed by Q&A. So throughout the webinar, please do use the chat function to post any questions that you have, and we'll do our best to answer these during the time of Q&A. We'll expect the webinar to last about an hour. So firstly, to very briefly set the scene on debt finance. So since the issuance of the first green bond in 2007, sustainability labelled financial instruments now include both green and social and are structured as use of proceeds and sustainability linked. Since the first issuance, green bonds have remained the most common type of bond instrument, representing 58% of the volume issued in 2022. In terms of other labelled instruments, social bonds saw particularly strong growth in response to the COVID-19 pandemic, and there's an emerging trend and interest in transition instruments, highlighting that debt finance can play a key role in financing emissions reductions. We're seeing interest in sustainability labelled financial instruments across corporates, financial institutions, municipalities and sovereigns, since the world's first sustainability bond was issued by Enel in 2019. We're seeing instruments across bonds, loans, letters of credit, revolving credit facilities, and more. In our panel session today, we're going to dig a bit deeper into the development of these sustainable finance instruments and look at how these are addressing sustainability challenges. We're going to ask questions like, how can we ensure that the instruments are ambitious enough? What innovation is taking place, and what role can the finance team play? Fantastic, so that's enough from me. So I'm now delighted to move to the panel discussion with our 2 fantastic speakers. So as a quick introduction, Melissa James is Managing Director and Vice Chairman of Global Capital Markets at Morgan Stanley. Melissa's work includes advising emerging growth companies on ESG stewardship in preparation for going public, structuring and executing ESG labelled capital raises, and helping companies think through their capital allocation decisions with an ESG lens. She sits on the Global Capital Markets Operating Committee and is a member of the firm's Climate Risk Committee, as well as Morgan Stanley's Women's Business Alliance Steering Committee. So welcome to you, Melissa.
Thank you.
We're also today joined by Tom Stewart, who leads a dedicated sustainability finance team at Sainsbury's. The team manages a $1 billion sustainability programme across carbon, water, plastic, food waste, recycling, biodiversity and social. Sainsbury's recently issued an innovative $11 million responsible commodities facility, which provides financial incentives for farmers in Brazil who commit to deforestation and conversion-free soy cultivation. So thank you to both of you for being here today. So I'll now kick off with the questions. So firstly, to you, Melissa, you've been at Morgan Stanley for over 20 years and Vice Chairman and Managing Director of Global Capital Markets for 6. How have you seen sustainability labelled instruments develop over this time? And what new and emerging trends are you currently seeing in the market?
Yes, well, thank you, Natalie. There has been, as you alluded to, a tremendous amount of evolution and development in the sustainable finance markets over the last couple of decades, dating all the way back to the first green bond issuance back, I think, in 2008, when the World Bank actually issued a bond that was underwritten by SEB, one of the Scandinavian banks. And that issuance really created the foundation for what has evolved to be the ESG labeled bond market, in that, that issuance contained a lot of the provisions that are still prevalent today in most ESG labeled financings. There was a very explicit definition of eligible projects. There was a second party opinion. There was, the added impact reporting became a key part of the process. And so those things have really remained sort of the hallmarks of best-in-class ESG bond structuring. But fast forward to a decade later, what we've seen is that the market really has blossomed. You've had now the International Capital Markets Association really define principles for various forms of ESG labeled financing that have become the international market standard for doing this type of issuance. You've had a broad array or diversification of issuer type. So, initially it was a lot of sovereigns and supranationals. Now the issuance is done by a wide variety of corporates and a wide range of industries, as well as municipalities and other entities. You've seen diversification in the type of instruments. So you mentioned use of proceeds instruments, whether they be green, social, or sustainable, meaning both green and social in terms of the application of the proceeds. And then also you saw the development of the sustainability linked bond. In fact, we did the first corporate one for a European utility back in 2019. During COVID, period of 2020 and 2021 really characterized tremendous growth in the ESG labeled bond markets. Issuance exploded. It really peaked in 2021 with about $1 trillion of issuance, as a lot of both private enterprises and government entities looked to try to relieve the social and economic disarray associated with the pandemic. So it became a much more mainstream instrument. So there's really been diversification in a wide variety of forms. The issuer base, the type of instrument, as well as the social themes that these transactions are financing, whether they be renewable energy or plastic waste reduction or clean transportation, or even social uses like education, housing, and healthcare. In terms of some of the new trends, I'd say, we're seeing a real increase in third-party reviews. As the markets become increasingly focused on rigor, and as concerns around greenwashing continue to mount, there is a lot of focus on credibility and rigor. And so, third-party assurance or third-party verification of, SBTs and, your allocation reporting is becoming increasingly common. Shorter allocation periods for application of the proceeds is also something that the market is desirous of seeing. The way the green bond or ESG label bond markets work is that you typically have a look back and a look forward period or window over which you can apply the proceeds from a financing. But increasingly, investors are desirous of issuers really applying those proceeds as quickly as possible, and preferably prospectively, as opposed to looking back at things that have been done historically. Because what investors really care the most about, given the pressing need around climate change in particular, is the idea of additionality and how quickly we can help mobilize capital to move towards a net zero future that we all are hoping for. So I think those are some of the trends that have occurred. Another thing that I'll mention is more granular reporting with qualitative case studies of how the proceeds are being applied. And then another theme more generally away from increasing rigor around structuring would be the theme of biodiversity. You've seen the TNFD, the Task Force for Nature-Related Financial Disclosure, looking to provide corporates with a disclosure framework that is not just focused on avoiding nature negative outcomes, but instead, focused on nature positive outcomes. So we've seen examples of biodiversity issuances in the capital markets, things like the World Bank emission reduction linked bond that was funding a water purification project in Vietnam, or the rhino bond that they did, where they issued proceeds that went to rhino conservation in South Africa. So those are some examples of some of the newest innovations that you're seeing in the ESG labeled markets.
Fantastic. Thank you, Melissa. It's great to hear of that innovation and new debt finance products and initiatives. So thank you. Next to you, Tom, Sainsbury's issued a 200 million green bank loan in 2014, which I believe is the first commercial loan structured in this way. And in 2022, as I touched on in the introduction, you issued the RCF to provide financial incentives for farmers in Brazil. It'd be good to understand from you, what motivated you to develop these instruments, and how has your approach developed over time?
So I think the shift from issuing our green loan in 2014 to our involvement in the Responsible Commodities Facility really reflects our expanding scope of focus from our own operations to our supply chains. So Sainsbury's, as many of you will know, is a food and general merchandise retailer, and we have supply chains across the globe. And we know that 97% of our GHG emissions fall within our scope 3. So mainly with our suppliers, but also end customers in general merchandise. So we're therefore particularly interested in financing solutions that can target our scope 3. And the Responsible Commodities Facility is a really innovative intervention that targets a high-risk supply chain by providing low-interest loans to Brazilian soy farmers in the Cerrado region on the condition that they do not deforest or convert. It's worth mentioning we did invest alongside Tesco's and Waitrose, so it's brilliant that we're able to collaborate in a non-competitive way on something like this. And it was of particular interest to us for a few reasons. So firstly, it's having a direct impact in a high-risk area. So the Cerrado region, which lies mostly in Brazil, is the world's most biodiverse savanna, and it's under threat from high levels of deforestation. And this is mostly driven by the expansion of soy cultivation. Secondly, it's independent of government, so the incentives are provided directly to the farmers. So that was something that really appealed to us. And finally, the support is provided in the form of a loan, so it's not reliant on continued philanthropy. And once a concept's proven, it has the potential to appeal to financial institutions and then potentially be scaled up. So yeah, really exciting thing for us, and yeah, really pleased to say the first year has been a great success. So collectively, we supported 32 farmers, which was conserving almost 9,000 hectares of native vegetation. There was zero deforestation or conversion. And with my finance hat on, there was zero defaults on the repayments of the loans. So the next step, I think, is all about scale. So I understand this year it's on track to secure significantly more funding. And the ambition is to, hopefully to get something like $1 billion+ US. And at that scale, then potentially they would be able to influence the big traders who have a lot of power within the supply chain. And the potential then would be able to create a new segregated supply chain to the UK or other markets that are demanding deforestation and conversion-free soy.
Fantastic. Thank you, Tom, and great to hear about the success of that initiative already. So thank you. Next, talk a little bit more about transition finance. And Melissa, in the answer to the last question, you're talking about, mobilizing finance for the transition. Could you just talk a little bit more about how you think the instruments currently in the market can be used to finance this net zero transition?
Sure. It's interesting. I feel like transition finance is a concept or a name that is often misused or misunderstood. It's a term that maybe means different things to different people, but we really define it as, bonds and loans in either use of proceeds or SLB format from primarily high emitting industries, even if they're not labeled as transition instruments per se. So, at a high level, we think of transition finance as financing for issuers that really meet one of two criteria. Either the issuers are from industries that are high emitting and that need to decarbonize by employing new technologies or strategies, for instance, adopting sustainable aviation fuel in the aviation sector would be an example. Another way we think about it is issuers that are transitioning their business model in favor of low carbon projects, like an energy company that's phasing out coal power generation in favor of renewables or low emission energy production. Some examples of financings that could qualify as supporting the transition would be, renewable power generation that's integrated with existing oil and gas activities, or use of production of biofuels in fuel or cement or basic materials, or smart grids and microgrids and transmission distribution infrastructure, financings that go to build out those things. So, sustainability linked bonds, which emerged in 2019, as we talked about, they, in our minds, have become almost like the de facto transition instrument, because I think they enable a lot of issuers traditionally excluded from ESG labeled use of proceeds issuance because they don't have adequate CapEx spend to tap into the sustainable finance markets. And if you look at SLBs, year to date, I think they made up just over 6% of ESG labeled issuance as of, the end of the second quarter. So that's, a relatively small amount, but, we are seeing it on the rise. We're seeing a slight uptick, I think, this year versus use of proceeds issuances, which still are preferred by investors, generally speaking. So, I think SLBs in our mind have become, sort of a good instrument to utilize to affect your transition plans, as a company in almost any industry. And, I think if you can have material, quantitative, predetermined, regularly monitored, sustainability objectives through very specific KPIs and sustainability performance targets, we think that this provides a very credible way to conduct your transition activities.
Fantastic, thank you. And just to pick up on that and sustainability linked bond and kind of the KPIs and SPTs that are selected, we see a lot of facilities, with reference to greenhouse gas emissions reduction. Be interested to hear in your experience, what other KPIs, SPTs are you seeing that organisations can use when looking at an SLB to finance the transition?
Yeah, I mean, I think that certainly greenhouse gas emissions reductions is one that we think is quite, quite relevant and credible, right? I mean, I think if the focus is on high emitting, hard to abate sectors, and, we're talking about really trying to, decarbonize the real economy, I think, doing that with credible GHG emissions reduction targets is, in our view, one of the best ways to, to do that. And so, in those cases, it's really about making sure that you have credible targets that are science-based or science-aligned. They don't necessarily have to be SBTI, verified, but certainly having them be science-based or science-aligned, in accordance with, some pathways, whether it be the SBTI pathways or the IEA pathways, some pathways that are, based on some scientific analysis. We think that's one of the most effective ways to, incorporate your, your goals, or sort of prove out your sustainability objectives.
Absolutely fantastic. And we'll come on to SBTI shortly and kind of Tom's experience of that. But just before I do, just another quick question around the kind of hard to abate sectors that you talked about. And we know, scale remains a major challenge in this area. What do you think needs to happen to kind of overcome these barriers for scaling those solutions in those hard to abate sectors?
Yeah, I think this is, again, one of these places where, to some extent, in the field of sustainability, we can let perfection be the enemy of good. I think the reality is that we believe that companies from high emitting sectors they're often unfairly the subject of criticism from investors or NGOs when they engage in transition financing, given the environmental legacy of their sectors like coal or gas-fired electricity generation, steel manufacturing, mining, et cetera. The reality is that, those sectors we have to figure out a way to help those sectors decarbonize. And, achieving net zero really requires that those sectors, move along a credible path towards emissions abatement. So again, governance, science-based, credible climate strategies, and the political willpower on the part of financial market participants, broadly speaking, to support these strategies, we think is incredibly important. We don't think that you can have an overly simplistic approach that relies exclusively on exclusionary screens when investing, because that will impede, in our view, the mobilization of capital towards climate action. Given the amount of capital that has to be raised to affect the transition to net zero, which some put, the estimates I've seen as high as $150 trillion. You need to be comfortable supporting projects and companies throughout their metamorphosis, including allowing for a gradual transition that's evolutionary, not revolutionary. And I can give you, some examples of, how you can provide the right incentive to decarbonize in the real economy and how you can potentially not provide the right incentives. I mean, we know of a situation where there was a utility company that was responding to market pressure by selling off coal assets instead of managing them down to eventually be shuttered. And they sold those coal assets to a foreign buyer who did not have sustainability as a high priority. And the new owner increased investments in the assets, which led to higher emissions over time, not lower. So which outcome is better? I mean, it's kind of like the debate about disinvestment versus engagement. You need to strike the right balance. And, as I said, sometimes in the land of ESG, I think we let perfection be the enemy of good. And that's counterproductive in our view in the long run.
Absolutely. And I like that point you made around that kind of evolution and focusing on, organizations that are transitioning, not just those that have transitioned already. And that's what we need to do if we reach net zero. So fantastic. Thank you. So back to you, Tom, and Melissa talking around, SBT targets and having kind of science approved pathways. So I know Sainsbury's has a net zero commitment and is working towards SBTI approval. So how do your debt finance instruments help you to achieve these net zero commitments, and kind of what's been the role of finance in this process?
Yeah, so on the scope 1 and 2 side, as you mentioned before, we agreed a £200 million green loan back in 2014. And this has been used primarily to fund energy efficiency initiatives. So it's a use of proceeds loan. So it's funded our rollout of LED lights across all our stores and various other programs. So this, combined with other things, has helped us half our scope 1 and 2 GHG emissions versus our 2018 baseline. And we, remain firmly on track to achieve our SBTI 1.5 degree net zero target by 2035. So that's really helped. On the scope 3 side, I wanted to mention an area where I think finance can support, but it's definitely something that I don't have all the answers on yet, but something I'm really, really interested in. So the majority of our scope 3 emissions happen at farm level. And one of the areas that we're looking into, and I think is really interesting, is around regenerative agriculture. So there's lots of definitions out there, but if you're not aware, it's broadly to do with farming techniques that regenerate the environment. So focusing on improving topsoil health, increasing biodiversity, improving the water cycle. And it has the potential to reduce scope 3 emissions through reduced inputs, such as fertilizer, and by trapping carbon into the soil. It can also improve crop resilience, so resilience being a big subject for finance teams. So improve resilience around climate events such as heat and flooding. And from the farmer's perspective, in the long term, the models show that they can expect better profits, as yields should be similar. Maybe they'll be a bit lower, but the key bit is that they're not having to rely on as many inputs to generate the yields, in particular the heavy reliance on fertilizer. However, the issue is in the short term, as they transition, there is a risk of lower profits as yields are likely to drop, and there will be still reliant some factor on the inputs such as fertilizer. So I think this is where green finance could play a role. So, how can we use finance to support farmers in the short term so that they can make that jump to more regenerative practices in the future? And I know there's a few companies doing some interesting things within this space. McCain's just recently announced a partnership with NatWest to support their farmers. So yeah, this is definitely an area that Sainsbury's is looking at the moment.
Fantastic. It's that kind of collaboration and working on those kind of scope 3 emissions and having that long-term view with partnerships. So thank you. So now back to you, Melissa. We're talking about net zero, and there's a lot to do if we want to meet net zero targets, and we need to move fast and we need to be ambitious. Acknowledging there's been some criticism in the market about SLBs not being ambitious enough, and sometimes financial impact can be negligible. So how can entities looking to issue these SLBs ensure that they're not subject to these criticisms and they are being ambitious in their targets to achieve net zero and other objectives?
Yeah, so I think at the end of the day, one of the most important things around your sustainability strategy and how you marry that with your financing strategy is to be authentic and to make sure that what you're doing is really material and relevant to your business. To understand kind of what your, what the sources are of your emissions footprint, and have credible plans in place to reduce those emissions. And so, authenticity, credibility in terms of your climate transition strategy is really critical to making sure that you are perceived as basically having a sufficiently ambitious program. So, as I said earlier, alignment to existing transition pathways, that's one way, having ambitious and well-structured targets, which, you can assess kind of relative to your baseline, relative to the level of to your industry and the level of difficulty associated with reducing, emissions across your footprint, whether it be, all 3 scopes. Will the targets result in overall absolute emissions reductions, particularly when you're growing? Things like, the inclusion of call provisions. When we look at instruments that are callable, ensuring that the appropriate adjustments to the make-whole provisions, incorporating the coupon step-up, are made should the bond be called. That's something that investors are asking for. Just to maybe illustrate the point about how to ensure you're sufficiently ambitious, I can perhaps give you an example of a company that we worked with that was an industry-leading provider of sustainable, high-volume, consumer-focused packaging. And they had goals were specific to their products and to their operations. From a product standpoint, they wanted to lead the industry by meeting and influencing customers' needs for sustainable product solutions from a packaging standpoint. And then operationally, they were looking to achieve, low impact manufacturing and integrate sustainability into operational excellence. And so they had previously published scope 1 and 2 emissions data, and back, all the way to 2018. And then in 2020, they'd set a target to reduce their greenhouse gas emissions for operations by 20% by 2025. But when we went to actually do the financing, they had already made very impressive progress against those targets. And so we worked with them to increase the level of ambition for their emissions reduction targets by adding a second SBT, a second reduction target for 30% by 2030. And I think, incorporating that second SBT was critical, I think, to having the transaction being perceived as being sufficiently ambitious. And, the market is sophisticated enough at this stage that there are a lot of investors who have evaluated thousands of these structures, have many of them in their portfolios, and have strong opinions around, what they feel is sufficiently ambitious. And so you do have the ability to get a lot of feedback from the marketplace, so things like introducing shorter trigger dates for evaluating whether a KPI target has been met in recognition of the need for near-term progress on climate action. That's an example of how you can introduce more rigor, building milestones into SBTs and providing, legal documentation or annual reporting on the KPIs and the SBTs that is independently verified to demonstrate your progress throughout the life of the bond. That is something that you can do to, increase the level of perceived ambition. And then external verification, as we talked about before, of historical performance, along with maybe KPI calculation methodology and data quality based on recognized standards. Those are just some examples of things that one can do to ensure that your transaction is perceived as, being ambitious enough.
Fantastic. There's some great points there around that kind of transparency and reporting and short-term targets, which is great. Thank you. So I've obviously got lots of questions, but people in the audience, please do use the chat function to raise any questions that you've got for Melissa and Tom, because we'll be shortly moving on to the time of Q&A. So back to you, Tom, and talking about kind of impact and driving positive change. You touched on some of the kind of impacts that the RCF had already, but could you just talk us through how you're measuring that impact, and how are you ensuring that funding is driving positive change and is ambitious enough?
Yeah, so the impact of the RCF initiative is measured by an independent environmental impact assessor in Brazil. So we think it's really important that it's someone independent, someone that's credible, to give the initiative that credibility. So they measure things like the level of deforestation and conversion, the amount of DCF soy produced, and the carbon stocks maintained. I'm also really interested in RCF's ability to scale, as I mentioned before. So I think about success around scale in 3 steps. So the first step was to prove the concept works, which we've now done successfully. The second step is to scale the initiative by bringing in new investors, in particular financial institutions who do this as part of their day-to-day and have their own environmental commitments. So our role, we felt like our role was to get the pilot off the ground and to prove the concept. And then the final step for me is whether we're able to reach a scale where we're able to influence the big traders and create a segregated supply chain to markets demanding DCF soy. So that, I think, would be really exciting, because what we would have done is created a DCF supply in a high-risk area and then connected it to DCF demand.
Fantastic, thank you. And you talked a little bit about kind of the role of finance, and maybe if you could just touch more about those unique skill set that the finance team bring to these kind of transactions, appreciating that a lot of the audience do sit within the finance team.
Yeah, so this was an interesting one for us to get over the line, because we don't lend money as part of our day-to-day. So it was something that we had to get our heads around. So my team got involved by building the investment case for why we the value that we thought in investing the money. We did the due diligence, looked at the different counterparties, worked with the legal team in Brazil. And then there was a big engagement piece as well, so engaging with our CFO and the rest of the business. So yeah, finance work kind of heavily involved from start to finish, alongside our sustainability team.
Fantastic, thank you. So we'll now move on to the time of Q&A. I can see a few questions have come in already, but if anybody else has got any pressing questions, please do post them. So the first one I can see is, how can a bank enforce that the ESG target has been met without the ESG targets being audited? So that's a situation if there isn't an audit in them taking place. How can the bank enforce if it's not been met? That might be a good one for you, Melissa, because you're talking about the kind of verification and auditing and the SLBs as well, the mechanisms in them for that.
Yeah, well, look, I think I wouldn't say that there's a specific role that the bank plays as an auditor of complying with your, targets or objectives. The reality is that you're relying on the corporate to, be concerned about their reputation, basically, in the marketplace. And there's reputational risk associated with not, following through or not meeting your stated objectives. Now, I think that reputational risk may be different because, again, this market is still evolving and there's still a lot of uncertainty around how greenhouse gas emissions, as an example, get measured. Scope 3 emissions in particular, there's still a lot of data integrity issues with respect to measurement of those things. So I think the market, generally speaking, is going to be and has been more forgiving when companies have not met their stated targets and objectives, if they have specific reasons and explanations for why that might be the case. So I think, at the end of the day, it's really, the onus is you're relying on, the corporate's focus and concern around the reputational risk associated with missing their goals, as opposed to, being the ultimate compliance officer or arbiter of what ensues if they miss them.
Thank you. I see we've got a question as well about clarification on acronyms. Sorry, it's finance, we often use them, but it's SLB, so it's sustainability linked bonds. If we're saying SLBs, that's what they stand for. And the other one we're using is SPTs, which is sustainability performance targets. So they're the targets that are embedded within the SLBs that have to be reached as a mechanism of the product. So next, kind of to you, Tom, a question around you've got your debt finance instruments. Could you just talk a little bit about addressing kind of different sustainability challenges? So we talked a little bit about nature, climate, people, and just where you see Sainsbury's using those instruments to really drive change in those areas.
Yeah, so as I mentioned before, I think scope 3 is a real focus for us. From a materiality perspective. That's if we look at nature, we look at climate, we look at human rights, a lot of our big topics getting into our supply chains is where I see the benefit, and then where we could identify these kind of targeted interventions. Having said that, we are also in the process at the moment of converting one of our facilities to a sustainably linked loan. And that, will have a climate focus, as most seem to do at the moment, including scope 3, but we'll also pick up food waste as part of that. So that's another important area to us as a food business. So I think, that will help with governance and engagement internally. So I think that's an important process for us as well.
Fantastic. And Melissa, we've talked a lot about kind of transition labelled instruments and a little bit about nature as well. Are you able to share some of the experiences of things you're seeing in the market around kind of social and people aspects embedded in these debt finance instruments?
Sure. And I should just add one thing to my last response, Natalie, which is I kind of presumed that it's well understood that, but perhaps I shouldn't have assumed this, that there's a coupon ratchet. So there's a penalty for a financial penalty for not reaching these SPTs, which acts as an incentive for companies to comply. And, banks advise companies on the appropriateness of that coupon ratchet. And so that's one way you can, as an underwriter, and help enforce effectively compliance with the goals by making sure that you have, credible and real financial consequences for non-compliance. But in response to your question about basically social and people aspects of things, it's absolutely the case. I think that organizations are focused on addressing social aspects of sustainability, and we've seen that happen in a variety of forms. We talked a little bit about sustainability and social bond issuance, sustainability being issuance that has both a environmental and social use of proceeds, and then social issuance being, obviously, issuance where the proceeds are focused on social considerations, like some of the things we mentioned earlier: healthcare outcomes, education outcomes, etc. One example was that we did that was basically a sustainability use of proceeds issuance that incorporated a social construct. Is we did a deal for a Swedish global investment organization that issued an offering that consisted of 2 parts: sustainability linked notes. And there were 3 KPIs in the sustainability linked notes. One was an environmental KPI, which was an SBTI approved greenhouse gas emission reduction target. But then the other two KPIs were both social in nature. One was the percentage of women investment advisory professionals, and the other was the percentage of independent women board members appointed at the investment managers' portfolio companies. So, incorporating social KPIs or a social use of proceeds is one way to effectively, address social aspects of sustainability in the capital markets. Another thing that we've seen on the equity side is, we did a transaction in the equity markets for a company called Allbirds, which is a basically sustainable footwear and apparel manufacturer. And they pioneered this concept of the sustainability principles and objectives framework, which was to really try to establish a set of criteria that essentially signified leading standard for top decile performance from an ESG perspective. And so they had 19 different criteria, many of which were environmental, but many of which were also social, that they essentially committed to comply with over the next, either at the inception of the IPO or over a period of 2 years hence. And, two of those social use of proceeds included, first of all, one was related to their value chain and making sure that basically they had policies and programs in place to monitor and enforce their tier 1 supply chain labor standards based on, on international, the ILO's standard of labor standards. And then there were several people related criteria as well, including committing to achieve and maintain employee diversity, committing to effectively establish a human rights policy, committing to monitor their median and disclose their median pay and mean pay gap, and then also even establishing a living wage requirement. So that's an example of a company that was very forward-leaning around social considerations and committed to do a lot of things upfront in that regard.
Fantastic. Yeah, that's great to hear. And I think it's also interesting that you'd referenced kind of facilities that have transition net zero and also social embedded within them. I think around kind of the just transition, things like that are so important to consider: climate, people, nature, all those different aspects in these facilities. The next question I had for you, Melissa, is a kind of big picture question, and it's around, at the moment, we've got all these facilities or instruments that are sustainability linked, and they're kind of seen as separate to the main instruments in the capital markets. Do you think there's potentially a future where all capital markets have to be kind of screened for sustainability or have that kind of sustainability lens on them? So is this kind of all of the capital markets are these kind of products? Do you think this is kind of an unrealistic thing or potentially an achievable reality in the future?
Yeah, I think the short answer is that I think it is an achievable reality in the future. And the evidence that I'd offer of that is the fact that, ESG has become an integral part of investment analysis. I think that whether you're issuing an ESG labeled instrument or not, both in the fixed income and in the equity markets, people or investors look at, environmental and social considerations as key risks and opportunities for the business, and they want to understand them. They want them to be managed and capitalized on appropriately. And so, I think if we look at the equity markets as an example, we would say that well over 90% of the market at this point employs some form of ESG integration analysis when they're doing their investment analysis, which is that ESG is just another lens through which they evaluate an investment opportunity. I can remember a big asset manager saying to me once that they basically had a large cap growth equity fund and an ESG fund, an ESG leaders fund. And when they looked at the two side by side, they were surprised at basically the overlap that there was in the holdings of those two funds. But what that said to them was that, ESG analysis was just another form of doing good fundamental stock picking and stock analysis. And so I think when you think about that, we have done a lot of research on this idea of ESG improvers, basically, essentially showing that, where there's significant potential for investors to achieve alpha, and is in situations where there's lots of potential upside for the ESG metrics to improve. So it's not necessarily about where you are today. It's really more about your trajectory and where you're going in the future. And so I think, if in fact this thesis proves out, and we believe it will prove out that these improvers will actually outperform, then I think it's going to start to, things like sustainability stewardship are going to start to affect people's cost of equity. And once it affects companies' cost of equity, that's going to flow back into affecting your cost of debt, which is in turn, going to affect basically how you think about allocating capital. And I think that's an environment or a scenario where this becomes much more mainstream and much more prevalent, and more commonplace, where every issue is effectively a sustainability issuance.
Fantastic, music to my ears. And then to you, Tom, we talked a lot about what Sainsbury's have achieved to date and the progress that's been made over the years. What's next? What are you working on in debt finance?
Yeah, so I mean, I kind of touched on it earlier. I think the big area I'm particularly interested in at the moment is around regenerative agriculture, and then again, we said we're currently in the process of converting one of our facilities to be a sustainability linked loan. So I think those will be big two pieces on the horizon for us.
Fantastic. And then to you, Melissa, around a lot of the people on the webinar will probably be sitting in real economy organizations and maybe wanting to go out to the capital markets with a sustainability labeled product. What kind of advice would you give them as what should they include in the information that they put out to the market? What are investors really looking for with these labeled instruments?
I think increasingly what investors are looking for is, again, back to these points that you hear often mentioned, credibility and authenticity. I think what they're really looking for is to make sure that the financing that you're contemplating really is relevant and material to your business. So whatever KPIs you choose, if you're doing an SLB linked issuance, needs to be things that are actually material to you as a company. And, there has to be some congruence between kind of your sustainability strategy and your business strategy. It has to make sense in the context of your, industry and in the context of your specific business. So, if you're a business, for whom basically water conservation doesn't really matter and is not material to your business, then don't, do a financing that basically has a KPI or something based on, reducing your water usage. Make sure that, the KPIs and the things that you're focused on are relevant and material to your activities, because that's, I think, how, increasingly, I think investors are looking at the totality of your financing strategy and your business strategy, and as I said, the congruency, how well they mesh together. Do they make sense? Are they credible? And then I think that's the basis or the foundation, and you build upon that, by essentially, coming up with credible targets and goals and objectives, and benchmarking yourself relative to your peers, making sure that what you're doing is consistent with market standards, doing things in accordance with ICMA, having second-party opinion providers, having third-party assurance and verification. All of those things, I think, add to the credibility of what your of your plans. So I would say the first thing is to get educated, to be thoughtful. And to make sure, again, that there is a real internal consistency. Don't let the financing, drive your sustainability strategy. Have your sustainability. It's really your business strategy that should drive your sustainability strategy, and that in turn should inform your financing strategy.
Absolutely, it's that kind of the strategy. Sustainability strategy should be the business strategy, and financing around that. Yeah, fantastic. Another question we've got is, taxonomies have not been discussed or mentioned today in relation to debt finance. Could we talk a little bit about that, comments on the use of taxonomy? So if you want to go, Melissa, if you want to take that first.
Sure. I mean, look, I think, taxonomies are incredibly important in Europe in particular, increasingly so, right? And I think, you are seeing taxonomies have an impact, both positive and negative, I think, on the sustainability finance market. So just as an example, if you look at SLBs, one of the impediments or headwinds to the growth of the SLB market actually is the SFDR regulation, right? Because this sustainable finance disclosure rules actually make it a little more challenging for investors to own SLPs than use of proceeds transactions, basically because you have to disclose the principal adverse indicators associated with your transaction, and it's a lot easier to do that at an activity level when it's a use of proceeds financing than it is to do it at the issuer level when it's an SLB. And so I think as a consequence, the SLB market has been impeded somewhat, by SFDR. And I think for the most stringent, funds, the Article 8 and Article 9 funds in particular, they may be reluctant or shy away from, holding those instruments because of the higher burden of proof that they require. So I think that, taxonomies can be beneficial in many respects. I mean, in terms of providing, a sort of a standard set of expectations and criteria that, increase transparency, increase comparability across industries, across issuers. But, there can also be some, adverse consequences as well.
Yeah, thank you. Anything you'd like to add, Tom, from Sainsbury's perspective there?
No, not much. I mean, our operations fall outside of the EU, so we're not directly hit by CSRD. But yeah, I suspect we'll probably get something similar within the UK at some point. So it's definitely something we're keeping an eye on.
Fantastic. So I think that probably brings us to time for the Q&A period. So just before we close, it'd be great to get kind of a final takeaway from our panelists on any kind of top tips that you'd have as recommendations for our audience today. So if we go first to you, Tom.
Yeah, top tips. Yeah, I mean, I like the point that Melissa made around that it should be strategy first, and that's certainly how we've approached our sustainability linked loan that we're currently working on. Is in want everything to be aligned. So having the targets that we're using for our REM, we can also use for the sustainability linked, so that everything's together. It's just building on top of that governance and engagement within the business. And then I think the second thing, so my focus today has been around these kind of targeted interventions. So I think I'd encourage people to think a little bit more creatively as well as to where you can use finance, maybe not necessarily a kind of more of the traditional sustainability linked loan, but is there something that you can do with your supply chain, where you're targeting a particular issue? So yeah, to have a think about that as well.
Thank you. And top tips from you, Melissa?
Yeah, I guess I would just say that, look, I mean, I think because I sit in the US, we're hearing a lot about, there's a lot of noise effectively that, people have to, navigate. But for what it's worth, we believe that this is a secular, not cyclical trend. We think that basically sustainability remains positioned for secular growth despite contending with the stresses of a bear market. We think that this is a field that's going to evolve towards more nuance and rigor, away from perhaps what might have been perceived or by some as an overly simplistic approach. We think all of that is a positive development. We don't see the secular growth story for sustainability fading. Rather, we see increased appetite in the market for strategies that employ a practical approach to advancing ESG efforts. And so if you're not up on this and you're not focused on it as a company, we think you should be. We think that it is going to require more, acuity, because we think, you're gonna have to confront competing priorities like, climate and the social cost of high energy prices. And you're gonna have to focus on things like real impact, and that's gonna be difficult to do. And so it requires a level of sophistication. It requires a level of, awareness and knowledge and, thoughtfulness that we think is only going to increase. So, we would just tell everybody to pay attention and to get informed.
Fantastic, thank you. So that brings to close the time with our speakers. So we've still got a few things to add from an A4S point of view, but just a massive thank you to Melissa and to Tom. Thank you for your time and thank you for your insights. That's been absolutely fantastic. So just before we wrap up completely, I'll just talk you through some of the A4S resources we have on the topic if you're interested, and then we've got a couple more poll questions. So A4S has been working on the area of sustainable debt finance for a long time, and we have published an essential guide on the topic, as well as recently published a top tips for treasurers on developing and implementing a sustainable finance framework. We'll post links to those in the chat function if you'd like to explore those resources. A massive thank you again to Melissa and Tom, and thank you also to those on the webinar today for joining, and enjoy the rest of your day.